Hello, founders and investors. Welcome back to Next Round Ready. I'm your host, Chris. Today we have special guest Mike from Generous Ventures. Mike, welcome to the show.
Thank you so much for having me on. It's great to be here.
Now, I connected with Mike because he's one of these people that's on LinkedIn that everybody seems to know and is connected with. And I think it's good to know these kind of connectors, because then you kind of just get connected yourself. That's kind of what happens. So, Mike, how did you get to this point of being an investor? How did you get here?
It was not a straight line on the bingo card, I can tell you that. I was the son of two child developmental psychologists. I learned about the brain, and my dad would give me electronics to take apart back in the day, so old fax machines and computers. I went to school for social sciences, so economics and public policy and education. And I ended up being, my first career, I was a middle school teacher to students with special needs in the Bronx and Harlem. That was not an obvious path because I tried to get into tech afterwards, and a lot of the replies would be kind of eyes glazing over, and they'd say, maybe you could join as like customer success in an ed tech startup. And I said, okay, we're going to do everything but that. I built a lot of communities. I worked as a behavior science based consultant for a little bit, where I was designing experiences for people that were way more memorable, compelling, and engaging than typical experiences. So think everything from communities for tech companies to getting influential people to go to WNBA games to mystery dining experiences. I was sort of along for the ride for those. Got into VC afterwards, and once you've had two careers where you're focused on making things interesting, compelling, and memorable, you kind of can't take off the rose-colored glasses of that. Worked at a fund. I was like an ecosystem, and basically it said, okay, you've built communities, build community for us. So I did. And then I decided to branch out on my own and start my own fund after that, using this behavior design kind of point of view to inform the kind of companies I would invest in, how I would find them, and how I would help them.
Yeah, that is a unique approach. I haven't heard anyone like that. I don't think I've met an investor yet that's told me they've been a teacher. Like, that's a totally different path.
I've met a few teachers, but I definitely have not met a teacher turned behavior science focused person turned VC. That's the unique Highlander style path so far.
And so as an investor now, how do you like it? I've started asking investors this question because I'm seeing a pattern of a lot of people going from I run my own firm, I'm in VC, to now angel investor path. I'm seeing that a lot.
Well, you're saying going from fund manager to angel.
Yes.
That means they couldn't raise, or they just didn't want to be forced to raise and deploy.
I think that has some truth to it. I do agree.
I mean, bluntly, I was talking with a GP earlier today, and they told me, they have good companies. They've invested well. They are known, and they still are saying, I'm not sure if it'll be easy to raise the next fund. And I'd say, you definitely can. You are doing well. You're making good bets, and I definitely would vouch for you in front of other people that I know. So I think the energy's out there. And I also run a community of probably 170 GPs. I've seen their decks. I see which ones probably will raise fine and which ones will struggle. Yeah, it's tough. So long story short, if they're angel investing after being a VC, they either did so well that they could retire, or they had so much trouble that they decided to retire.
Ooh, that's a controversial one. I like it. Okay, you know what? Let's go controversial VC opinions. I want to hear some more of these. It sounds like you got a lot of them.
Funny. Yeah, the nice thing about being a solo GP of a stealth fund is that I can, if it's a true opinion, it's not trying to intentionally bash anybody. I don't really have anyone I have to report to for my opinions. It's really entertaining. Do you have a particular topic, or you just feel like, tell me your most controversial stuff?
Trust me, I got a ton. I'm always trying to find because this is the hard thing for me as a host is I have this fire in me that I need somebody else to kind of riff with. You know what I mean? And not all, like you just mentioned, some of the investors, they just can't have that conversation because of who they answer to. They can't be blunt and honest. And I'm not even saying mention names or be mean or disrespectful. We're not talking about that. But just being more honest and truthful about the startup venture capital world as a whole. I think we need to have a few more real conversations versus always being the cookie cutter surface level stuff. You know what I mean?
Well, I agree. Well, I can tell you, I used to host an event series called Real Talk, where I would literally get two people that are usually on the opposite sides of the table in a room and say, you can't attack people, but you can be unfiltered. Nothing comes out of this room. Oh, stuff got real. We had some fun conversations.
That's the only way it can really happen. So let's take a step back. I want to ask you a couple questions, and then I want the brutally honest, the truth for all of them. So let's start off with the AI boom. I think so many companies are throwing AI this and AI that into their whole stick. And I would love to hear your opinion on that from an investor perspective.
Well, I think there's definitely a big wave. If you look at it in the ocean, there is a tidal wave coming of a lot of things going that way. I think there's a few things at play. Like, yes, we had foundational models that crystallize their ownership of the market that are doing things very well. I'll be curious to see how they do once there's a lot of lawsuits that have been filed about how they got their data and how they train their data. I'm not going to say everybody's going to get it, but it'll be. I want to see how Perplexity does and how Anthropic does in terms of where did they get their information? Was it easy? Was it copyrightable, etc.? I think there are a lot of applications being applied to. We had a wave maybe 2 years ago of everybody had an AI-assisted SDR, AI-assisted sales, things like that. Everybody had one in their portfolio. I think we're now getting to okay, can we build big companies in specific verticals? I'm very curious to see where we have hype and curiosity revenue turn into, oh, this is tangible outcome for us. We need this value consistently. Like Harvey, there's been mixed opinions on. They do really well. They have great revenue growth. But I've also heard some people say, yeah, they're not actually finding it as helpful as possible in the law firms, and we wonder what's going to happen with renewals. I don't know. These are hearsay on both sides of the argument. I run a community of legal tech investors. I should ask them, actually. But I think there's a big wave. There's going to be a lot of things caught up in the wave. There's going to be some random logs and some random stingrays you're going to get stung by if you're riding that wave. I think we're going to see a lot of growth. There was a big question also about a year ago about enterprise adoption and sort of integration and implementation, saying, how do we actually get people at scale to use these things? So those are the big questions. Where I play is usually beneath the big waves. I'm talking to the nurse sharks and the crabs on the bottom of the ocean that are doing their thing, living a full life and building the companies. So like I invested in a company that does AI automated pharmaceutical manufacturing compliance. Really, you're
Wow.
building a batch of pills. Something goes wrong, you need to find out what, because you stop the whole assembly line until you can assess specifically what went wrong and how you're fixing it. And that company, I invested at a $3.5 million post-money valuation on a 500K round. That wasn't a fluffy round. They're still building it out. They're still getting the thing done. But I've done everything from that to, I'm trying to think, I have AI-enabled customs compliance for supply chain. And that was a company that I got in at a very good revenue valuation. I think the more vertical you go, you'll be able to find the companies. There's
Yes.
a point of view that there's a lot of kingmakers right now. That if you get a great Series A, your success getting to a Series B is much higher. And same thing if you raise a very big seed getting to a Series A. So there will be some successful companies coming through. I would be curious to see what the curiosity revenue looks like when it translates to long-term utilization. I'll be curious to see how capital efficient some of these companies get and whether the public markets are going to support a company raising their first round ever at a 600 million valuation, then going IPO for 650 billion, up to $1 trillion. We'll find out. I don't know yet. I mean, I think there's a lot of precariousness when Jensen Huang will say, oh yes, if we have a bad quarterly earnings, we have a whole tumble effect across the entire economy, because if NVIDIA goes short, then what does that mean for AI and what does it mean for blah, blah, blah. And so I think there's a lot of hope on this. There are some fundamentals that are dramatically improved, like the number of times that I've used an AI platform for work that I have to do. It's there. It's a tangible value. It's not like blockchain.
Yeah.
People can find a realistic use case. Trust me, I saw all the blockchain companies alongside the AR, VR boom, the big data boom. I think we're seeing things are made faster. Things are made more tangible. The valuations being justified for that, I don't know. I think talent is very concentrated. People are willing to pay the price for that talent. But I'm not going to prognosticate and say every single company will succeed or every company will fail. I think it'll be interesting to see when companies are too big to be acquired, when they're going for insanely high IPOs, what's the market appetite going to be? I mean, that's ignoring a lot of the things in the macroeconomic side where, given governmental situations and large macroeconomic policies, do we even have a very thriving stock market at some points when we have one of, like, if NVIDIA falls, where do these companies IPO? Who's going to pay for it? So there's a lot of uncertainties. That's why I like investing in companies that will never need hype in order to succeed,
I
because
love
they have
that.
a stronger ecosystem without it. Like my best company didn't announce anything till their Series A, and they're doing fine. So that's my view. I think you can ride the wave, have a great surf. There will be some great outcomes. There will be some ones that are a little bit questionable, but you've got to be very strong in terms of the risks that you're taking if it's not clear why they've earned the valuations they have.
I love that full breakdown. Guys, if you're listening, Mike does talk fast. I didn't speed it up. This is how we talk.
If that was me talking at normal pace, like I can try to talk at a 1x
No,
pace.
it's fine. It's fine, man.
No, not for
Let's
you. Saying like I can talk slower. One of my friends bet me one time that I couldn't, and I did it for a day, but then I was exhausted just slowing myself down, which happened.
right. Just your pace is good, man. So I gotta ask you this: how often do VCs give advice for founders that's good for the fund but bad for the company?
Oh, very often. I think the bigger the fund you have, the more that the incentives are skewed. I remember, I think it might have been, and you can quote me on this, I might be wrong, but I think it was Tiger Global, because I remember I had a pretty strong taste in my mouth from the example. But I remember a VC had talked to me about a company that Tiger Global was involved in, and they basically said, there's two things I think happened. One was they said you have to grow more at scale. You have to burn more money to go bigger faster, even though the founders were doing healthily and they didn't want to. And then when they were running out of cash because they had burned so much trying to scale, that fund didn't continue on and support them. I've also heard other stories of you think about the incentives. If they get one big exit under their belts, a lot of partners will say, I'm good. And then they either just try to divest from everything else to reduce their bandwidth or do something else. I think if you understand the incentives of anybody, you understand how to operate. If you look at a big fund and they're underwriting that no company can fail and they all have to exit for 5x, then you know what their incentives are. And if you are going to try to sell at 2x what they sold for, it doesn't match their thesis. Like Sequoia has even said, I think some partners, if it's below a 3x, it's a failure, which I think is fine because you got to kind of get at least above 3x to be considered a decent fund. But yeah, they give terrible advice all the time. I've seen a lot of people that try to overgeneralize from their personal perspective. There's a lot of narcissists in venture capital that will give an opinion saying, this is what I did, so therefore you must do it. And I think the fewer qualifiers that you hear in somebody's advice, the worse it is. If they say, hey, this is what I've seen, this is the data, you can follow it or not, there's another point of view. Yeah, some VCs give amazing advice, some give terrible advice, and I think the biggest thing is to have a sense of curiosity and triangulate amongst a lot of data points. If you listen to the customers and the customers know what they need and there's a business case to be made, most often you're not going to go wrong. Sometimes you know what they need ahead of them, and then that's a special case. But yeah, VCs give bad advice all the time, and they give good advice all the time. I haven't met a lot of VCs that get out of the way.
That was going to be my point. Is I talk to a lot of investors now on the show who some of them have kind of a superior complex, like a God complex. Like, I know everything because I work with so many companies, because I have the money, I know it all, and you have to listen to me. And if you don't, you're now not a humble founder. Nobody will invest in you. Your company's going to fail. And it's kind of a weird dynamic that they put on a lot of founders where it's almost like their ego runs the show. You know what I mean?
Yeah. I don't care if I'm right or wrong. I'll tell them what I've seen and what I think the risks are, and I'll say that's not a risk that I choose to underwrite to. That's fine. It's like dating. You don't tell somebody what to do. You let them show up as who they are. You can say what you appreciate. You can say what resonates. You can say what you're looking for. And if it doesn't match, it doesn't match, and that's okay.
I love it. I appreciate your honesty on this. So I would love to hear some stories, some examples of some of the companies you've invested in, some of the founders you work with, where it just didn't work out. You know, I think that sometimes founders hearing the failures, hearing the bad stories, can learn some lessons from them.
In terms of it didn't work out, like the company didn't work out or the round didn't work out for me investing?
Specifically, the round didn't work out for you investing. Because I think, again, the perspective on a lot of this stuff is always talked about from just one side. And what I want to do is kind of flip it a little bit, you know?
Yeah, and I'm going to bring up my NT portfolio so I can track the companies because I'm trying to think of the right ones. So I know, well, one that happened in August was I was at the M25 Summit, and M25 is a great venture firm. They invest in Midwest companies at the pre-seed stage. They had sent me a company that I said, oh, this is really compelling. I invest in vertical AI. I love that. And they had sent it to me. They had sent it to a few other folks. And when I got to the event, it was kind of like the most compelling woman in the high school hallways. I'm coming in as somebody who's like, oh, I'd love to talk. And then somebody who was a GP of another fund, I literally walked in and I saw him kind of talking with that kind of energy of like, oh yeah, here's what you got to do, this and that, as if it was like the football quarterback hitting on the woman. I was like, well, if he takes the whole rest of the round, so be it. There's no room left. And I talked to the founders and I said, hey, we'd love to get a wish list of what you're looking for help with because I incentivize every one of my LPs to help the companies. And when we ended, I was like, yeah, let me know. I'm happy to figure out what works. They never followed up. And I texted them and they never followed up. And then I found out that that investor had invested in the round. And that's okay. Like, you're not going to win every single deal, but it was one where I said, look, I gave my full effort. They were already convinced and they wanted to bring in one investor. And that was fine. So I lost that deal, but it's sort of just because there wasn't room left. If there had been room, I could imagine I might have gotten it. What else have I lost? Or what didn't go through? Okay, now I got to refer to the NT portfolio.
I like that breakdown because I don't think founders realize what it is to you as an investor to lose out on a deal. They think that they're so focused on them fundraising themselves that other perspective of, hey, this investor might have lost out on this company or that company doesn't really cross their mind. So I appreciate you sharing that.
Yeah, it happens. I mean, nobody wins all the deals they want. Actually, no, some do if they're a small enough check and they're getting in early enough. But yeah, I mean, most people expect that. I think some really good funds are like they will lose a few in a month. I know of funds that have a very good following and have a decent reputation, and they just don't win every deal. Depends on what you're going for. Okay, here are ones that Where's another one that I missed out on or I didn't get into? There was a company that I was taking a look at, and it just closed insanely quickly. Actually, I remember one. There was a company that I was looking to invest in, and I was running a $3 million fund. I was gonna say, okay, 50K on an $8 million post money, and I said, yeah, I will invest in that company. I gave a verbal. I was like, yeah, let me know when you're ready for the rest of the round. And then I found out that their lead investor had come in and said, we're putting in $1 million on this $7 million post. You can bring in some other folks on 10 and then some other folks on 12, and then everybody else can come in at a 15. Or I think they just said, we're doing $1 million here and you can tranche it out as you want. And so I went from getting 50 on an 8 post before this founder got the commitment from the other fund. He came back to me and said, we can't do that, but we can give you 25K at a 15 post. And I said, so you're pulling my ownership by 4x. I can't make that work. And also, you raised one round with no difference in traction. Why would we get multi-tranched in to all these different prices just because of that? And I said, look, I verbally committed before all of that happened. I'm not doing this for that low of an allocation. And also, it's kind of shady for them to say, we're getting our ownership at this low of a valuation, figure out the rest. The founder told me afterwards he would have just taken 2.5 on a 12.5 post and called it a day, everybody at the same terms. And I was like, yeah, you probably should have done that. But that didn't work. That fund is well respected by founders, but I know of multiple people who got boxed out of deals doing alongside them. So if I ever see that fund on a deal, I'm like, we're just not going to do it because I don't trust that the terms are going to be consistent, and I'm going to be considered as a partner on the cap table rather than just them doing their thing and anyone else can follow along.
Wow. See, and I don't think that part of kind of the dark side of venture capital, most people don't know how gritty it can get in terms of boxing out. Can you explain that for the founders listening, what boxing out means?
It means that for a fund to invest what they want to invest, they need to get a certain ownership. And usually a simple rule is divide their total fund size by 5. So a $50 million fund usually needs to own 10% of a company going in. A $10 million fund needs to own probably 2% of a company, etc. And so they need to own that. That's the promise because that's how they underwrite their outcomes to saying if a company gets big enough, we own enough of it to return our fund. And so they have a minimum ownership requirements of percentages. And so if they're writing $1 million check, they have to invest at a certain valuation to get the ownership that they need. And so boxing out means I'm taking my allocation. There's no more room. It's like when you got a basketball, there's only one person who can get the rebound. So you box out the other people to get to it. So that's what it means. It means somebody else took the money open, invested it, and then there's not room for everybody else out.
Absolutely appreciate the breakdown, man. I know the founders are loving this conversation because you're one of the investors I've spoken to on the show that's a little more candid, and we need more of that. I'm trying to encourage them to, but everybody's terrified. And I try to tell them, hey, I can edit out whatever you say. Like I can remove it. We're not live. Like it can be edited. I want to talk to you about the down round for you. What has that been like for you as an investor?
I'm trying to think if I've had any down rounds. As an angel, I had a few down rounds, where I put in a small check and then they raised at an 8 million valuation. Then all of a sudden they're getting acquired at a 3 million valuation. I said, well, that's not going to happen. I've had some companies shut down. I don't know whether I've actually had a company that has had to raise a down round that survived. Either they shut down or they raised a flat round or they raised a higher round.
Hmm.
But yeah, I mean, it'll happen. Maybe that's because I don't invest in a lot of companies that are raising far above their skis. So they're not saying, I'm going to raise on a 30 million valuation with $100,000 in revenue. I'm like, no, if you're raising at 30, usually you're there. I might have some companies that shut down because they weren't willing to take a down round. Actually, no, there is one. There is one company I invested in. I take it back. I just was talking with them last week. I invested in an $8 million valuation alongside some funds that you've probably heard of. They raised another round, I think about 4 million on a 22.5. And right now they're taking in about 1.5 million on a 15 post. And that's mainly because they have built the product for a long time. They say they're going to be they're at about 150K ARR, and I invested in 2021. So they don't have a lot of revenue. But they believe they finally have cracked the enterprise go-to-market, and they think they'll be at about 1 million in revenue at the end of this quarter, 2 million in revenue next quarter, and about 6 million by end of year. If they pull it off, they're in a great shape. And then it was a very small check out of the beginning of my fund, so it's not going to be a huge make or break unless it's 100x. Otherwise, it's less than 1% of my fund at total size. But yeah, they're raising a down round. And it's basically whether people are willing to believe. And I told the founder, I was like, look, if you need some bridge money, you might have to raise 500K on a $5 million post, because you can either take 10% of your company away and have it survive, or have nothing. So it's your choice. The craziest down round I've ever heard of was actually a founder that I met. I'm not going to reveal what they do because it's a little bit too revelatory. But they were doing a company that I think makes sense. They had raised a seed. I don't know what they raised at. They raised a Series A. Or no, they were trying to raise a Series A and they were struggling to raise it. And so at one point, I believe they took a $100,000 check from somebody I know on a $1 million valuation. And that company is now worth hundreds of millions. And it's the highest performing markup that fund uses in their deck. It's like, oh, we're up 177x. I was like, yeah, it's because you invested a sizable check and a down round into a company. But yeah, that $100,000 is worth, I guess, right now, let's see, 177, about 1.7 million. No, that would be 17 million.
Performing very well. Yeah, and I think that's why I asked about down rounds, because again, it's one of those things that we don't talk about a lot. Like, what are you as a founder willing to do to save your company? Is it worth you keeping all of it to say and be at zero, or will you give up a little bit more so you can kind of survive and get another at bat to try to make it work? Because that injection of cash could be that thing that you need to really propel you to that next level, versus having nothing and you just be at zero, start from zero somewhere else.
Yeah, and I think there's a couple things that come into mind. One is a lot of founders get really exhausted fundraising. I'll tell you, like, I know founders that had to go through 200 no's to get to a yes, and then they finish their round. And I talked with the founders, they're like, look, if I got to raise in a really low valuation, I'm going to be demotivated and it's not worth it. And so I invest a lot in founders who come from the industry that they're working in. So not the number one PM at LinkedIn is now building something in a completely different space. I'm like, I invested in a fourth generation waste hauler building a SaaS enabled marketplace for waste hauling. Yeah, he's going to keep doing it because he's been doing it his whole life. My best performing company is a former radiologist building a radiologist provider network and workflow. And so a couple things. One, founders get exhausted on that. And two, I think there's you got to really be balanced in terms of where you think the right amount of hope is and where you're just like beating your head against a wall. I've seen founders that have raised for companies and I was like, great, you did not find any customer demand. It's okay to shut it down. And like, no, but we can build everything out. If we do 5 more features, somebody will pay for them. Like, maybe, but the odds are very low. If you don't have a fundamental customer need right away, it'll happen. And like, yes, companies pivot, but you got to either iterate at a really fast speed or you got to be onto something very quickly. But frankly, I will say the other time, sometimes it's just surviving long enough to have that chance, which I will agree with.
And I think that might be a hard thing. I was just talking to Charlie O'Donnell about this, about hearing the no. And just realizing that this idea isn't going to work, that it's the wrong market, the customers don't want it. I think that's a really painful conversation that founders kind of run from. Do you as an investor ever deal with that, where you're like believing in a company so much and then you have to realize like, wait a second, this is just a no?
Wait, in terms of it's a no from me for the company?
Yes.
Oh yeah, I'm a dopamine addict. Everybody gets it. There's been companies where I like to believe in it, and then the more you talk to customers, and they say, we don't really need it. I was looking at a company in the health tech space, and I liked it a lot. They had pilot revenue that was really compelling, and then I talked with and I knew people that invested in the company, and then I talked to some other VCs who were doing diligence alongside of me, and they said, yeah, we just couldn't get to the things I heard was, one, we couldn't get to the belief that the founder was going to be able to raise down like further downstream for more rounds. Founder was kind, wonderful person, just they didn't have a clear, they will go through walls to make it happen. And then two, the biggest thing was we talked to customers and they were like, yeah, we don't actually have a huge need for this. So they had gotten through one pilot and they had this was on a $7 million post and they were at, I think, a $2 million pilot. If it converted, they would have gotten it. So it was a very reasonable valuation. But anyone we talked to, now that said, you can't always trust subject matter experts unless they're the ones who be the purchasers. My best performing company in the radiology space, one of my LPs was looking at it. They had a radiologist who kind of poo-pooed on the idea and they passed. They could have made $20 million from the company if they had invested at the point that I said for the check size they wanted to do. And so they're not happy about it with that person who said no, but they've learned their lesson. So yeah, sometimes you're wrong, sometimes you're right when you pass on things. I have passed on companies that have done really well. I have said yes to companies that haven't, but I'm grateful that I've said yes enough times to the right companies.
Wow. See, and you're one of the new age investors. It's so interesting. Me talking to so many, it's kind of like my own filter in my mind now of the old school kind of investors and the new age who are like operate differently. I had one investor recently tell me this, and their episode has not gone live yet, so don't try to go and look, people, that they still focus on institutions, that they really, really care about where a founder went to school. And that's just so old school. And I've never hear that from investors like yourself or people who are just look at things a lot differently. Not saying it's necessarily wrong, but I think it's just such a limiting point of view that it's a really interesting thing to hear from an investor at this point in 2026.
Well, I will say this: like, there are indicative points. Like, you want someone smart, you can go to a place where the odds are higher that they had something in the gray matter area to build a company. That said, I've crashed some summer MBA parties for some well-known business schools, and I wasn't impressed by the people. I was like, "You're regular people. You're fine." Especially encouraged by that fact. I know people have gone to great schools. It doesn't always mean that there's anything particular to it. And I remember the same. It used to be the same thing for VCs. Like, I remember looking back on fund pages in 2017, 2018, and every GP of a fund was a Harvard MBA. Not the case anymore, clearly. So, but like, if someone says, "Hey, I want people who are like," there are funds that index only YC. There are great companies that go through YC. They also have an 80% plus failure rate. And so you can either do a whole index, in which case you might be fine. You can pick the companies that you really want to work with, in which case you might be better than fine. Everyone's got their own factor. Some people invest in the hustlers, some people invest in the traction, some people invest in the product experience POCO. I invest in the people that are bottoms-up customer insights. And so it really depends on which company it is. I think it's stupid to say that pedigree is all that matters, because maybe I've invested in one or two Ivy League grads, but not intentionally. They were just really compelling and they happened to go to an Ivy League school or something.
Love your perspective on that. Something I've heard you say multiple times now. I had to bring this up before we go. You don't invest in companies that need hype. And I would love for you to explain and elaborate on what that means, because I think every company is dying to put themselves out there on a billboard, or be it South by Southwest or whatever it is, and do the press releases. And you seem like you're going in the opposite direction. I would love to hear more on this.
So you get a company that needs hype. What does that mean? It means there's going to be a lot of competitors coming behind them because everybody knows, oh, this is a great idea, we should do it too. It means that they're probably going to have to raise a lot of money in order to sustain and have a war chest against those companies, which means I'm going to get diluted to oblivion for that. It means that they don't have clear customer demand, or there's a clear compelling problem. They might get some leverage from it, but there's so many more risks that come with it. And I like companies that have a first principles basis for why they're going to succeed. And so they can have hype, but they don't need it. It shouldn't be that if we don't get a key name investor or a TechCrunch article, we'll never succeed. That's the company that needs hype. If it's a, hey, we don't mind being in TechCrunch, we don't mind being in Axios, but we're still going to operate and still going to build, that's different. It's not companies that will never have hype, it's just that they don't need hype. And so I'd say, if you're a clear yes for your customers, not just, oh, we like it, but here's our contract, we need to pay for this right now. You know how to get in front of a lot of customers capital efficiently, meaning they have a high trust, a high social proof, or a high velocity customer network in terms of how they share, and you know how to capture a lot of value from it. Why would you need hype? I have a company that is stealth in any communication that I put out to my LPs. They can know it if they ask me, but I invested when they were at a $24 million valuation. They had $8 million revenue run rate and profitable. They didn't need hype. They figured some things out. There's some pivots they've had, but I think they have like 12 years of runway. And they only raised $3 million because they wanted to bring in strategic partners. Yeah, that's it. That's what I got.
Love that breakdown, man. Mike, this was an incredible conversation. I appreciate you being here and sharing your insight expertise with us.
Yeah, happy to be here. Thank you for the questions, and I appreciate the real talk.